We are live, Jimmy.
We are live. Welcome to Tradier, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. Together, we do the show live every Wednesday at 4 o'clock. Thank you guys so much for joining us. You can also catch us at unfilteredinvestor.com. Bobby, today, stock market's ripped. Here's what I thought, and I want you to poke holes in my thesis. I don't care what the chairman said. I don't care if he threw a wet blanket. As a matter of fact, I didn't even read what he said. The second I saw that he was restarting quantitative easing, and you know this has been my base case for a couple of years, and one of the reasons I own the irresponsible with the dollar portfolio, which is gold, silver, platinum, whatever. As soon as he said he's restarting quantitative easing, to me that's bullish. You?
Yeah, I agree. And there's other parts of it in there that are bullish. A lot of people were calling me saying that this was a hawkish Fed meeting and a hawkish statement. And all I saw in that was the restarting of QE. And a second thing I saw was the bond market not being afraid of resurgent inflation. And I think that may have been because the Fed was actually less dovish, where the market said, okay, right now the dot plots have one more cut. That's it.
Yeah, but quantitative easing wipes that out, doesn't it?
To us, it does, yeah. But I mean, I look at it like you look at the yields, and I'm really glad we're talking to who we're talking to today. But you look at the yields, they didn't budge. 10-year yield did not budge. It actually dropped a tick. So we're less afraid of inflation than we were yesterday, is the way I see it.
That makes sense to me. And as you know, I say this all the time, is that you guys have been listening to Bobby and I for 20 years. Sometimes you think we may be full of shit, and sometimes we think we're full of shit. But one thing you cannot deny is, for some odd reason, fantastic guests say yes to our show. And today is no exception. We have one of our favorites, Dr. Sri Kumar of Sri Kumar Global Strategies. Let's bring him in. Been way too long since we've talked to you, my friend. How are you? You look great. Where are you living now?
Well, I'm in the fire-affected part of Pacific Palisades. If you remember, almost a year ago, January 7th, we had that massive fire.
Yeah.
So I'm doing this Zoom, and I've asked all the construction crew to stop for an hour so they don't make any noise when we are still talking.
That makes sense. Yes, that's good. And how's the weather there? Everything good in California?
Yeah, very different from Chicago and New York. I saw all the freezing going on. Here, next week, we are going to have 80 degrees. Yesterday was 78.
Oh, good for
That's
you guys.
beautiful.
That is awesome. Okay, you heard what we were just talking about the Fed. I viewed this as very dovish that they're restarting QE. By me saying they're restarting QE, is that an accurate assessment of what's happening in your mind?
Yes, QE has resumed, Jimmy. You're absolutely correct. How has it resumed? They announced at the end of the October meeting that December 1st, they would stop quantitative tightening taking place on the Treasury side. And on the mortgage-backed securities side, whatever maturities took place, they were going to take that cash and they were going to put it into the Treasury side. So in other words, the Treasury part of it, the balance sheet is going to be increasing. And what is quantitative easing after all? It is an increase in the Fed's balance sheet, and that is very much taking place. This is something I wrote about several months ago. I said quantitative tightening will stop. We are talking about the Fed's balance sheet as a proportion of GDP, which used to be about 7% before the failure of Lehman Brothers in 2008. It is somewhere in the close to 20% today. And it is not going to go back to the old levels. You may say, well, the balance sheet should be larger when the economy becomes larger. And I agree, but it doesn't have to be larger in proportion. So clearly there is a problem with the Fed dominating the economy more and more. And that's why we are all waiting eagerly every time to see what the Fed is going to decide.
What did you make of Jerome Powell's excuse for the quantitative easing? And I may have the wording wrong on this, but he said something to the effect of maintaining the proper balance sheet in order to be able to help manage the economy. First of all, what do you think he meant by that? And second of all, is that the dumbest thing you've ever heard, or are there dumber things you've heard than that?
Well, there are few dumber things other than that, but there are lots of them which come from this chairman on a regular basis. And I've been very critical of him, and it is almost easy, Bobby, to anticipate what he is going to do next. Because whatever you expect, he will do that, ignore all the explanation, and look at what he wants to do. At the end of the October meeting, he said, do not take a December rate cut as a given. It may not happen. And remember, the markets backed off when that happened.
Yeah.
And I wrote in my weekend piece, ignore it. He will be pulled like a chain by the markets, and he will do what the markets want him to do, and he's going to cut rates again. Now, they are saying they are not going to cut rates in 2026 to the same extent, but they will. So all of this dot plot and forecast simply don't make any sense to me, because they do whatever is appropriate at the time at which the decision making takes place.
So, Bobby, can I ask you a quick question there? Because it's been my thesis for a long time that if we get a week before a meeting and the futures markets say that there's above 80% chance that they will ease or tighten, that they enter their blackout period, I don't think they have a choice but to do what the market demands, even if they don't think it's actually the right thing to do. I think they just shrug their shoulders and say, we didn't message well enough. We have to do this. Do you agree?
Jimmy, you are absolutely correct. And I'll tell you why that is a correct statement. If the markets are predicting an 80% likelihood of a rate cut, and then it kept going up further and further beyond that, if the Fed chairman and his FOMC decide not to cut, they're going to cause a crash in the market because the markets are expecting it. That's what I mean by saying you're not independent. It is as if you have a chain connecting at the nose, and somebody is dragging you along, and that's what is happening as far as this Fed is concerned.
That makes good sense. Bobby?
I actually just found the statement. For those of you that don't know what statement I was asking Shri about a second ago, in the statement it says the committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis.
Bullshit. So, he's trying to buy bonds so the Treasury doesn't freak out if nobody wants to buy long-end bonds. What do you think of that, Sri?
That is exactly what is happening. And look at what Scott Bessent, the Treasury Secretary, is doing. He was critical of Janet Yellen, his predecessor, for borrowing short-term rather than long-term. He's doing the very same thing now that he is in office. The whole thing just reeks of hypocrisy in terms of policy making. They do what they want to do when they are in office. They criticize that same policy if they are in the opposition. That's exactly what is happening here. And that is one reason why the 10-year and the 30-year have not gone up further in yield, because the Treasury is borrowing in the short term. And I have a sneaky suspicion that something else is happening, that government entities are also stepping into the market to buy longer dated Treasury securities, because they cannot afford to have the 10-year shoot up in yield. So they have to do anything to show that the big, beautiful bill is actually going along nicely. And they have to do that by trying and getting into the market and buying the long-term bonds.
So I'm trying to understand, when you say other government entities, in theory, who could you mean? You're not accusing any government entity of doing it specifically, but when you say that, who do you mean? Like, in theory, who could that be?
You have the federal mortgage entities which can do it. Those would be my, I think, principal candidate for purchasing at a time in order to support the Treasury yield. And also look at the timing of Jerome Powell announcing the end of mortgage-backed securities being reduced in size and taking that money and putting it into treasuries. That again brings the yield down. And that is, I think, being reflected in the bond yields today. They came down a bit because they are anticipating the Fed is going to help in terms of purchases.
So
So
where does the
you go.
fiscal responsibility need to come from? Obviously, we have to slow government spending somehow, but somebody described it to me a couple of weeks ago, like Scott Bessent has come into a house that's being flooded, and he's using a squeegee to get rid of the water, and it's coming in too fast that he can't go find the source of the water. He just has to keep squeegeeing it out of the house, or they're going to drown. I don't know if that puts the picture, put it in my head pretty well. What do you think has to be done in order to stop this? I heard somebody today say that total government debt is getting close to exceeding the actual dollar value of the US economy.
Well, the federal debt is actually already 120% of GDP. So you're talking about 38 and a half, 39 trillion divided by 24. So you have a big difference between the two already. And I like your analogy, Bobby. Let me go back to it.
Please.
It is not just using a squeegee to take the water out of a flood in the house. They are further flooding the house, which is already suffering from being underwater.
That's
The
great.
big, beautiful bill is going to add to the federal debt and the federal deficit over the next 3 years, when you already have the debt to GDP ratio being extremely high and the fiscal deficit being about 6.5% of GDP. We find fault with France, which has 5% and change in terms of the thing of the deficit. But the United States is about the worst in terms of fiscal deficit among the large industrialized countries.
So do you think this is a two-part question, because I want to talk about Kevin Hassett. He actually spoke even more dovish than Jay Powell was a couple hours before the meeting, and that's probably he's posturing to get the job as Fed chairman, which I don't barely even blame him for that. But secondly, when you look at 2026, like my trade has been to bet on the irresponsibility of the federal government. So I've been long silver, gold, real estate, Bitcoin. There's other things too. What derails that trade? Do you think that there's going to be a come to Jesus moment where the federal government says, wait, we can't spend as much money? Will that happen?
I think the only way to derail that continued progress is a crisis.
Okay,
If there is
crisis.
a bond crisis, equities crisis, or a combination of the two, both of them taking place. A year ago, I took the position we are headed eventually towards stagflation. And that is a tough forecast to make, because the last time we had stagflation was late 1970s, early 80s. We have not had that since. Why would I say it is going to happen again? Stagflation requires willful mismanagement of economic policy. You need to get lots of warning signals. You need to be ignoring those warning signals and proceed ahead. And when the deficit is very large, we introduced a big, beautiful bill. We then bring in tariffs and we impose them on friendly trading neighbor countries, like Canada, for instance. What did they do to deserve it in terms of being attacked by the United States? When you do all of that, you're going to have inflation remain high due to tariffs, and unemployment has gone up because the economy is taking a hit from tariffs. If you cut interest rate by a quarter point, half a point, 1 percentage point, you're not going to cut the unemployment rate. It is dependent on a structure. And we say in economics, there are two different things. One is a structural phenomenon, like unemployment coming due to tariffs or AI, the impact of them. Those are structural developments. Monetary developments only affect inflation. And I am a critic of the Fed because they say they are going to control both inflation and unemployment. And we had a Nobel laureate Dutch economist known as Jan Tinbergen, who passed away a few years ago. And there is something called a Tinbergen rule, which says when you have one instrument of economic policy, at most you can achieve only one objective, not two objectives. And so what the Fed does is it follows a seat of the pants policy. Today you say Powell wants to cut interest rates. So he says, oh, unemployment is the real problem for us. If on a future date he wants to think about inflation, he's going to say, well, I have to increase interest rates. Inflation are a problem. There is no scientific logic to that. There is no basis to the decision making. And that is also why I think we are headed toward a stagflationary situation. What's the problem about stagflation? We found out with, again, Jimmy Carter's presidency, we found out with Ronald Reagan coming to office and Paul Volcker as the Fed chairman, stagflation is extremely difficult to get out of. You have to squeeze the economy, literally strangle the economy to get out of a stagflation, which is why you want to avoid it rather than try to cure it.
So I have a question from our friend Remo. It's Stock Charts on Twitter. He wants to know who is your choice for the new Fed chair if you were the one appointing that chair. And do you think that the president will announce it soon or closer toward May?
Sri Kumar. I'll ask that question. Sri Kumar is my choice. But anyway, you, Sri, what's your choice?
Let me put it to you this way. If Bobby, if you're saying who do I want to be Fed chairman, I can give you one kind of answer.
Okay.
If you said to me who would I pick among the candidates who are lined up, I would give you a different answer. What is the
Let's
question?
get both answers.
Okay. First question, who would I choose for a candidate? That person was somebody who was interviewed by Donald Trump in his first term.
Mm-hmm.
One of the professors on my PhD committee, John Taylor, who is currently at Stanford, he's the author of the Taylor Rule.
Taylor Rule, right?
Why didn't John make it even further into the race? John is very principled. He has a theory, he has a rule, and he says this is how you would increase or decrease. And when the president wants him to keep cutting rates like crazy, I'm sure he would have said, I can't do that. It depends upon what my equation tells me to do. You need a principled economist and a theory behind it rather than shoot from the hip. And so he would be my candidate, but he would never make it because of those are not the qualities the president is looking for. Now, in terms of all the people who are there on I don't like any of them. They are all going to listen to the president and they are going to cut rates like crazy. And why don't I like them? I don't like them because my big fear for 2026, and since you both are interest rate people oriented toward the fixed income market, let me say that very clearly, I think the yield curve is going to steepen. You can cut the short rate, but that doesn't mean you're going to make the economy very strong because the long end is going to rise. And if that happens, it affects mortgages, it affects the economy, and that is not what we want to take place. And that is, I think, the result of cutting rates indiscriminately.
So my follow-up to this is, when you look at the scenario now, from a perspective of them cutting rates today, Jim Bianco said something interesting after the rate cut. The vote was 9-3, right? And Jim Bianco said, I would have liked to have seen more dissension. Because if it was 7-5, I would feel more comfortable. And the person he was being interviewed by said, why would you want that? Wouldn't you want the Fed to all be in line? And he goes, no, because we're about to have a new Fed chair. And if there was more dissension with this current Fed, then I would believe that they weren't just going to do what the Fed chair wanted. So what they proved to me by having it be 9-3 is that whoever gets put in the Fed chair seat is just going to do what the president says, and everybody's going to go along with that. Do you agree or disagree?
I agree with Jim's position. I wish also that there had been more dissensions. And I say that for one more reason, Bobby, than what Jim may have been thinking about. And that is the following. We pay these people from the taxpayers' money, their salaries to come to the board and to think and express their views. We don't pay them to go on TV news programs and explain themselves and explain all the differences there. If you have a difference, stay in that conference room, decide on what you want to do and explain all the differences and make it very clearly. I think the public and the investors deserve the attention of hearing the true reason why they are voting the way they are. More dissensions? Great, fantastic. We still would like to come up with a result, and you can see why they decide the way they did. And that's not what happens now. I think what Jerome Powell did at today's meeting is that he corralled them to make sure there were not more dissensions, because it makes him look bad. And that is the opposite of what we want for good policy making.
Okay, so there's something I disagree with you on, which is not a very comfortable position with me, because I think that you're one of the smartest guys. You said about stagflation. I have a thesis that AI is AI is disrupting the labor market already, and I'm not certain it's for all the right reasons. I think there are plenty of companies out there who aren't adding headcount because they think AI is going to make them more productive and more efficient. And I think they're thinking it's more of a mature product than it might actually be. And maybe it will be. But I think that a technology that's as powerful as this, and I use it quite a bit, is disinflationary. Do you think there's any merit in my thesis? What do you think is going to be the impetus of inflation? Is it just going to be liquidity and government spending?
I would agree with you, Jimmy, going a good part of the way. Technology is disinflationary. We saw that with the advent of computers in the earlier part of the 20th century. We saw that with the dot-com boom in the 1990s. But find out what happened. The dot-com boom by 1999 went to excess. And people thought that anything that has a dot-com after that, you should go and buy that stock. And you should be investing a lot in terms of how much investment expenditure you're going to make. Similarly, and neither of them panned out. The dot-com boom, in fact, crashed in 2000, 2001. And after that, we are still using computers. We are still using Wi-Fi. It has improved our productivity, but inflation hasn't disappeared. And the reason for that is we always find a way to go the other way to increase inflation by other means. If there is AI-related productivity improvement, you're going to see so much investments in AI, so much consumption of electricity to keep the AI going, that's going to contribute to inflation. You're also going to have inflation because people who should not be in that sector just called themselves an AI firm, invested more money, and they are all going to go down and they're not going to contribute to disinflation.
So here's my question then. It sounds from those words like you're saying that some of the AI trade that's been in the equity markets is stretched and might be a little overblown. If one, is that the case? And two, if it is the case, are you looking to other areas that might be second level, third level beneficiaries of AI and advancements?
It is not a second level, third level, not necessarily in terms of sectors, but companies and managements which are well managed and where the investment is done of a proper form and size, rather than indiscriminately investing in AI, those few firms are going to succeed. What is my guess? I'm going to say to you, if you have a total of $1 billion going into AI, probably about 80% of that is not going to survive. It is only 20% or so which is going to be really productive, and they are going to do very well. If you invest in that 20%, you're going to do well as an investor as well.
Got a comment from our friend Widge that I just wanted to get your take on, Shri. Widge says Sheila Barr would be my pick, but she has no shot since she would be independent. Do you have any opinion on that or no?
Yeah, she would be a good candidate from outside. And because she would be a good candidate from outside, she will not be chosen.
Right. And that's really a shame. Is there any chance that Kevin has it? Because this is a Bob Stein we had on. We love Bob Stein. He's a friend of the show as well. But one thing he said about Kevin Hassett, and he knows them personally, is that don't think, okay, maybe he's posturing. These are my words, not Bob's. Maybe he's posturing to get the position. Once he has the position, he believes he will take it seriously and not just carry water, bootlick, whatever the euphemism we say is for the president. Do you think there's a chance of that?
I don't think so. The way in which the behavior has happened and how cloying Kevin Hassett has been in terms of following the Trump dictates, I think he's not going to change once he becomes the chairman. And in the last couple of days, look at the statements he has made. He has said, I'm going to remain very independent because he has to say that to pacify the bond market,
Of course.
because the bond market already has concern about Kevin Hassett. But having said that, he says, I think under the current setup, we need to cut interest rates massively from where we are. So, in other words, I'm going to be independent, but I'm also going to cut substantially. This
Yeah.
reminds me of something where I say to somebody, I would like to get your unbiased, favorable opinion on what I have just done. That's what this is like.
That sounds like what I ask for all the time. I want your opinion, but only if it's a good opinion.
Right.
Yes, Bobby.
I wanted to ask you about the dual mandate. And Jimmy, just so you know, I'm having some technical problems here, so I might log out after this question and log right back in.
Sure.
The dual mandate. It always seemed to me that full employment was almost as stupid to give to the Fed as, DEI was to give to the Fed.
Right.
They would speak before Congress and they would say, yeah, Chair Powell, we would like to work with you on figuring out how to bring equality to people of color and all of it. And I'm sitting there going, what the hell is Jerome Powell going to do? Like,
Right.
what can he do about this? Is the employment mandate just as silly as that? Should it just be price stability like it is in a lot of the other central banks?
You're absolutely right. That's why I referred to the Tinbergen rule earlier during our conversation, that you should have only one objective. And for the Fed, monetary policy affects prices. And therefore, that ought to be the only objective. Now, you might say, hey, employment is important. Who's going to take care of that? The Treasury and fiscal spending are oriented toward employment and economic growth. The central bank should be oriented only toward inflation. So, yes, I would very much agree with the statement you made.
Can we take a quick time out? Luis, will you put up the banner? This is the part of the show where I make a pitch for a favor from you people watching. Tradier has been so kind to host our show and sponsor our show. Can you do us a favor? And that's scan the code and try Tradier Pro for 3 months for free. We talk to options traders who have been doing it for decades, and some have been doing it for days. And they all say the same thing, is that this program is absolutely the best for pricing options, for conducting strategies. You guys will love it. Just scan that code, try Tradier Options Pro for 3 months for free. Thank you for your consideration. And now back to the show, Bobby. Oh, are you logging out or did you log out? He's gone. Sri, are you still there?
I'm here. I can hear you.
Okay, so prior to we have been a big fan of the second derivative AI energy trade and futures edge and on the trader's edge. We talked about silver, copper, and nuclear as well. Do you think those things are real and they have legs, and those are places that people should be to support the data centers and the electric future that we're pricing in?
When you say to be in, you're talking about
to be
ancillary.
to be long silver, to be long copper, to be long nuclear. Are those things that are good investments for people right now?
I would separate gold and silver on the one hand from nuclear on the other, and I'll tell you why. I think gold and silver, the reason why they have shot up in price, silver has done even better than gold in a fabulous year for both the metals. And the reason that is the case is because it's a flight from paper currencies. The dollar can go from
trade.
debasement trade. The dollar goes from 1.03 to the euro at the beginning of the year to, let's say, 118 later in the year. But then after a while, you find that what do? You can't go and hide just in euros with all your cash. So basically, you take the money out of the paper currencies and you go into gold and silver, and that's where I think the play is. And with another interviewer at the beginning of the year in February, I said the gold is going to go to 3,700 by July. This is when it was still trading at 2,700. I know it was not 3,700. I was wrong by $100. It actually hit 3,800 by
That's
July.
right by $100 in my mind. Yeah.
And my expectation now is by the end of 2026, we'll hit 5,000 for the gold.
Interesting. But what about then the electrification trade is what I want to get to, the nuclear and copper and things like that. Do you think that's a reasonable investment strategy because of the electrification needs of AI and crypto for that matter?
Yep, they are going to benefit enormously as well. The question really is, are they allowed to do that? Now, there is also a political angle to it. If the price of electricity goes up, the electricity company does well, and if you bought stock in it, you're going to do well. But what happens to the people who are common people, low income people who have to pay more for electricity? And they are the ones who are voting in elections, and they say, we don't like the situation. And does the government bring some form of controls into the whole part? If they don't do it, and the free market is allowed to play its role, Jimmy, I would say you're talking about very positive for the electricity or the nuclear trade as well.
Bobby?
Sri, do you have any, do you do any research on productivity at all? I'm trying to figure out right now if what I think the inevitable productivity from AI is in the economy or not. When I look at productivity numbers from the U.S. government, which of course were interrupted during the shutdown, there's not an unusual spike at this point. But I honestly don't know if that's where I should be looking or not.
Well, I have not done a study of the productivity improvement due to AI simply because it is a very tough one to put your arms around. What are you going to consider and where are the changes going to take place? But what I can say, as to continue with the previous team I mentioned, for every 4 of them who go in, three of them are going to fail. So you're going to have productivity improvement coming from the remaining 1/4 of the investment that you have made. The remaining 3/4 is going to be wasted, going to push up inflation, and they are not going to contribute to productivity. So that
when oh, I'm so sorry, Sri. I just wanted you to fill this in too. Is that you've mentioned inflation a few times? It's interesting. So, do you think the economy is running hot right now? Do you think the labor market is bad? What do you think?
I think the inflation is running hot now. And if we do cut rates 2 or 3 more times, as I anticipate, it's going to run even hotter in 2026.
What about the labor market? Do you think the labor market is crap right now, or do you think it's okay?
The labor market, based on the latest data that we have had over the last 10 days, are showing relative health. You cannot be growing forever at 3.5% to 4% unemployment rate. We are still in the low 4s as far as unemployment is concerned. Initial jobless claims, which came out for a recent week, was the lowest since September 2022. So these do not say to me that the employment picture is a difficult one. Now, now that you mentioned that, Jimmy, let me have one other thing added on here. The Federal Open Market Committee met yesterday and today in making the decision. Next week, we are going to have the inflation number come out, the jobs numbers come out after the Federal Open Market Committee met. I am a critic of the FOMC even meeting this week. If they did not have the data, they should have postponed this week's meeting until you have something decent to decide on. What did they do?
What an excellent point that is. Thank you for making that point. That is a tremendous point. Why the hell didn't they? Everything else, we don't know when numbers are coming out. You know, I look at my Bloomberg terminal and we don't have any idea when numbers are coming out. Sorry, I didn't mean to interrupt, but that is a fantastic point. Thank you.
You are right. They should have postponed it, but they did not. Why didn't they postpone it? Because they think they are on top of the situation with or without official data. Christopher Waller made a statement saying, I get enough information from all the private sources. Then why do you have the Bureau of Labor Statistics? Why do you have the Commerce Department calculating them? You can remove them and Elon Musk will be happy. The Doge can be used to get rid of whole departments. So the
Bobby?
thing just
Yeah.
escapes it as to why they should do this.
Okay,
Love
so
it.
President Trump calls. He says, Shri, we need you. We need you as Fed chair. You can reform anything you want to reform. What's the first two things you do?
The first thing I would do is, again, something I've been recommending for a while. I would say, thank you, Mr. President. I accept the position. But at the same time, one big change you need to have is my term as chairman should be only once for 7 years. And I cannot be renominated. It's a crucial part of it is to say that the chairman's term is one term. The Mexican president, for example, is elected for 6 years, and he or she cannot be re-elected. That's it, once and done. And I think the chairman should be once and done, because that way you don't spend the rest of your time politicking to make sure you're appointed again. So, Bobby, that would be the first thing I would say. The second point I would make is that I should be allowed to implement a rules-based policy. We can get rid of most of the members of the Federal Open Market Committee. They don't have to come to work every day. They don't have to make TV statements contradicting each other and causing confusion and market volatility. Stay home. The computer and a good rules-based theory can take care of what should happen, whether interest rates should move up or move down. For instance, in the case of John Taylor's rule, he says in an equation, if inflation is above your target, you should increase the interest rate. Another variable is the unemployment rate being above or below target. If it is below target, increase the interest rate. If unemployment is above target, cut the interest rate. Having done that, go home. Goodbye. You don't have to stay there. All of those. That would be the second recommendation.
So two things. Number one, how do you think markets would react to that? Would just go out the window in terms of an input to market participants like Jim and myself, right? Because we would say, okay, we just saw the data. We know what's about to happen. And the second part of that question is, are you a fan of a Federal Reserve at all? I mean, to me, there's obviously an underground movement to delete the Fed entirely. And I'm always of the opinion, it's like, the horse is out of the barn. So it's a little late to do that. It would certainly be a crisis if you eliminated the Fed today. So first of all, how do you think markets would react to rules-based? And second, do you believe in the Fed as an entity at all?
Great questions, Bobby. Let me start with your first one first. How will the markets react? The market will be a lot more calm when that happens. As you said, you would come to work and you would know exactly what the Fed is going to do, because you can do the equation, run the equation yourself, and you'll come up with a result. And you will know whether the interest rate is going to be moved up, moved down, or kept the same, unchanged. And that, I think, is good for investors. It is good for capital accumulation. You remove the uncertainty to it. If I'm running a company and I want to hire workers, I can go ahead without the uncertainty caused by the interest rate fluctuations. I know exactly where they are going to be. And I can say to myself, inflation is higher than target, so I should be careful about hiring more workers because this is going to be difficult. So all of that is going to be very positive on the production side, productivity side. You said, do I support the Fed? From all what I have said, you might think I don't support the existence of the Fed, but just the contrary. I am an old-fashioned monetarist. And I think rather than Bitcoin and all the other substitutes for the currency, money should be something which is issued by sovereign governments and the banks in that sovereign area, which follow up to what the monetary policy is. So I think there should be a Fed. I think the Fed should continue to exist, but it should be more disciplined and much more rules-based than it is today.
So here, and again, I agree with you 100%. I couldn't agree anymore. Like, I think we could pick out probably 15 data points only and blend those into our economic forecasting and our Fed decision. But the one thing I do worry about is we talked about when you see inflation. I don't have much trust in CPI anymore. Is trueflation better than CPI? Is CPI with its hedonic adjustments and its really weirdly weighing housing? Is there a better way to measure inflation that you could think of?
Every measure of inflation has its positives and negatives. So you're not going to come up with a perfect measure, I don't believe. So in a sense, that you have the consumer price inflation, wholesale price inflation, headline inflation, and core inflation, excluding food and energy. And then you have the Fed zone PCE inflation index, which is their favorite index. The fact is, you have all of these numbers, and they should be produced in an unbiased fashion from month to month. And you let the people decide what it is that they want to take.
Are they produced in an unbiased fashion, though?
Despite, I think, the president's attack at the previous BLS, Bureau of Labor Statistics commissioner, and having her fired, I think they are relatively unbiased to the extent they can. I'm not saying they are error-free, but I'm saying they're not done with any political motive in mind. That when she, Erika McCann-Taffer, who when she came up and said that the unemployment is high, the employment did not increase very much, and the president didn't like it. But she did what she could within the resources she had under her control. That's all.
Bobby, I have a question for you. Why I thought EJ, who's kind of, I mean, he goes on Scott Shelley's show. He's was part of Heritage, and we're friends with Kevin Roberts. So I always kind of consider him in our circle. Why didn't he get the gig? Do either of you guys know? He was supposed to be the head of the BLS, and then all of a sudden he was not. Does anyone know what happened there?
No, I assume there was some sort of personal thing. I didn't really hear anything publicly. Shri, did you hear anything about that or no?
I did not. I don't know what the reason was that he was not chosen.
Yeah, no, that was an odd one to me too. Bobby,
I mean, unlike you, Shri, if the president came to me and said, we'd like to put you in this position, I'd say, do I have to?
You'd say yes, though. We'd all say yes, though, right?
Yeah, I mean, you have to say yes to the president, right?
You
You
have to
just,
say
it doesn't
yes.
matter who the president is, you have to say yes.
I told you my story about the phone call when the president was coming to Chicago, the phone call I got.
Yeah.
Yes.
You ready to talk about that publicly yet?
I'm not sure. The person on the line said it's, and then a name that you'd all recognize, Trump needs a favor. And I said, I'm not killing anyone. But anyway, I did the favor. I won't talk about it publicly yet, but it was an interesting moment to be right at the center of things for a second. But Bobby, what's your question?
Yeah. So where do you see the economy from a perspective of growth versus decline? Obviously, it seems to me like the Fed is leaning a little bit more towards recession than they are towards inflation getting out of control. The dot plots, the SEP had inflation going from 2.8 to 2.5. So that's a drop from September. I don't necessarily agree with that, especially if President Trump sends out checks like he's talked about.
Oh, Jesus. Or 12 billion to the farmers, too.
I know,
Christ,
I
sorry,
know.
sorry.
It's you just can't keep writing all these checks, but they still do. It's so depressing if you think about it too long. So which way do you lean? I know you said a year ago you called for stagflation. Do you still call for stagflation? I think a lot of people, I'm sorry, Shri, I'm jumping in on your answer here, but I think a lot of people misunderstand what you do. You make macroeconomic calls. You don't say where the market is going in the next month or even in the next 6 months. You see how things line up, and you say, with the picture that I see in the near future to the medium future, this is likely to happen, not guaranteed to happen. So which way are you leaning right now?
First of all, in terms of stagflation, we are already going through a mild stagflationary phase. Look at what we are going through. We have unemployment pickup. We have inflation remaining high stubbornly. What you would normally expect, that as unemployment started to rise, inflation will come down. That's not taking place. Both of them are deteriorating. So you do indeed have a mild form of stagflation. The question is, does it get better or worse as you go into 2026? And as the determination seems to be to cut interest rates significantly by whoever Trump nominates to be the next Fed chair, I think the stagflationary situation would worsen. Recall my saying, stagflation requires a lot of bad policy measures to actually become fully successful.
So I have a quick question for you, because you said you thought the curve was going to steepen. We've been hovering around 50 basis points, 2s to 10s for quite a while. I think the average is about 104. We also know today that the Fed wants to drive down longer term rates, or else they wouldn't have restarted quantitative easing. At least that's my thinking on it. So do you think then the Fed, it's going to steepen because they're going to be focused, whoever the next chairman is going to lower rates on the short end, and the Fed might not be able, they might lose control of the long end? Is that what you're saying?
Exactly. Both
Okay.
your points are exactly what I'm saying. You, the Fed, or the new Fed chairman, you keep cutting the interest rate at the short end, the federal funds rate, and therefore the 2-year rate goes down with you. However, you don't control the 10-year and the 30-year. Even if you do some quantitative easing, the question is deficit is going to increase. And if you misuse that ability to do quantitative easing and purchasing of long dated bonds, soon you're going to lose total control. You become like an Argentina where the inflation takes on a life of its own. And that's my fear, that we are reaching the stage, the deficit is reaching a level we have not seen before. The total debt to GDP is at record levels, and the debt is increasing at a time when the economy is growing, which is the opposite of what you would expect. So all of those make me very worried about how things would turn out in 2026, that inflation is going to become at some stage uncontrollable.
Yeah. But this is a question to the viewers too, and you guys can put in the chat, or Bobby, if you know the answer, that's fine too. If I've plenty of times had steepener trades on. You guys, most of you know, I put one on when yields were negative and rode it to a little bit of a profit, but then I got out. If I was going to put it on, I'd do either the 2s versus 10s standard contracts or the 2s versus 10s yield futures contracts. Is there a way to put on 2s versus 10s in the ETF market? Do either of you guys know?
I've never tried to do it. So
No,
I've
I
never
don't think
tried.
there is.
I've never even looked at it because we have a vehicle that we're comfortable with. You know?
Yeah, right. We use futures, so we would do that. I know the TLT, I think their duration is longer than 10 years, and I don't even know what the short, I don't know how to do it. Again, if you guys want to hit me on Twitter and tell me how you do it in the ETF world, just because of a curiosity. But Bobby, you got the last question. What do you got?
Yeah. So I was setting up a question here, and then Widge put a similar question into the comments, the live comments. So my question is this: what has to happen for housing to loosen up so that young people can buy houses? And then Widge actually put the question in. Luis, if you can put that up. Widge says, how does housing fit into your forecast for 2026? Price correction versus level of activity. How far can prices fall before creating domino effects? So this is sort of a two-part question. What would you do to help people afford houses again? And then what's your housing forecast and how does it fit in? Price correction versus level of activity.
First point I would make is housing situation, making it affordable, is again a structural question. It is not a monetary question. If you want the housing to become more affordable for the young people, you want the house prices to come down, but that will happen if the supply increases. There are areas where people do not want multifamily homes coming up in the neighborhood. We may have to allow that to take place so that there are more houses. Too many restrictions, too many rules on how your house can and cannot be built. And you have to make sure that that is removed. With all the issues we have had with commercial real estate, the ability to convert some of them into housing in the major cities, that also would reduce it. So all of those, I think, are the ways of having it done. And this other area is, people say to me, what do you think about reducing the mortgage rate, and will that increase the demand for housing? No, it'll worsen it. If you cut the mortgage rate, there'll be too many people demanding the housing. And if you don't have a similar increase in supply at the same time, the house prices are going to go up. They're not going to go down.
So tell me this,
So,
because the housing regulations, which I love your answer, by the way, but we are now electing essentially socialists in New York, in California, Miami now, and I don't know that she's a socialist in Miami. I just saw that she was a Democrat, and it seemed like the Democrats have moved so far left. So my question is that I don't see any blue skies on the horizon for reducing regulation. We may do it on the federal level, but the states and the cities are going to pick up that slack and increase regulation and make this problem worse. Now, I mean, I know that Mamdani saying rent control is the quickest way to make housing prices go higher. I'm talking to the people watching, not the street. He knows that. But what do you think it's going to get worse or better?
the immediate movement is going to become worse. What I'm hoping for even starting from Mamdani in New York City and elsewhere, is that they realize that some of the socialist policies they come in with are going to be detrimental. And to the extent he, for instance, is very young, he has a future in politics. He's going to be thinking about what's my next job. And they would realize in turn that you have to allow for the housing supply to increase. And rent controls are not going to do it. So what I'm saying, Jimmy, is that you go through a tough part first, and that may be 2026 before you start to improve from 2027 onward with a correction in policy.
I was hoping that tough part was going to be 2025 and that 2026 was going to be the easy part, but you could easily be right. Bobby, you can still hear me, right? I'm having a little bit of difficulty with technicals. I'm going to play us out if that's cool.
Yeah, I can hear you. We're good.
Okay, good. So that's it for today. Dr. Kumar, tell them how they can find you on Twitter or on your website.
It is, again, my website is srikumar at srikumarglobal.com. And I am on Twitter. And again, the handle is at Srik, S-R-I-K, Global. And you can see me there as well. And then
thank you so much for joining us.
Every Saturday, I put out my report, and that is on Substack. And that is another way that you can, there is no paywall. You can read it every Saturday.
Something great about Sri's report. Some of these people, they put out newsletters like Jim and I, we put out about a 21-page newsletter, but a lot of it's pictures. But Sri puts out a newsletter generally fits within one page. So it's an absolute joy to read because you read it and you always think to myself, how did he get so much information on one page?
Thank you. Thank you very much. I appreciate you saying that.
Yeah, it's wonderful.
Okay, well, good. Good. Thank you guys for joining us as always. I love the live component of this show, and thank you so much for the interaction that you give us. We have the best supporters. I will never call them fans because we're fans of you guys as much as you're fans of us. Thank you guys for watching the show. This has been the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. Also, please join us at unfilteredinvestor.com, and we will see you next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.